Problem 2-1. On July 1st of 2016, Roland Company exchanged 18,000 of its $45 fair value, dollar par value shares for all the outstanding shares of Downs Company. Roland paid acquisition cost of $40,000. The two companies had the following balances at July 1st of 2016, and they give us Roland and Downs balance sheets. Okay, and remember that Roland is the acquiree and Downs is the company that they're buying. The following fair values apply to Downs assets. And they give us some fair values for the assets. They want us to record the investment in Downs and any other entry necessitated by the purchase. And they want us to prepare a value analysis and determination distribution of excess schedule, and then do a consolidated balance sheet for July 1st of 2016, immediately subsequent to the purchase. So right after they make the purchase. Okay, so over here, they're not paying any cash for the company. They are giving them 18,000 shares of stock. Their stock is worth $45 a share. So they're paying $810,000 for Downs, for the investment in Downs. Okay, then the balance sheet they have here, this is Downs. This is for the company that you are buying or that's being purchased. All right, so we have other current assets, inventory, land, buildings, and equipment. And they were 70, 60,000. 40,000, 120, and 110. All right, the liabilities were current liabilities, and that was it. Current liabilities of 60. And then make sure that you write their equity down here under equity, because you're not going to use it to calculate net assets or anything else. So it needs to be kind of separated out. So they had common stock of 20, 80, and 140. Oops. This is excess and retained earnings. Okay, then they tell us the fair value of Downs' assets. So this is still 70, inventory should be 80, land should be 90, the buildings are 150, and the equipment is 100. And the liabilities stay the same. Okay, so you want to add up both of these. So notice that, for the book value, you want it to tie out like the balance sheet. But for fair value, you're going to have the total of the assets, but only the liabilities. All right? Because you want to be able to do the net assets. All right, so here, your net assets, well, it's fair value net assets. So fair value of net assets will be the 490 minus the 60. So $430,000. Okay. All right. Now this right here will help you calculate what goodwill is. All right. So we paid $810,000, and we bought all the outstanding stock. So actually up here, you could put our ownership percentage is 100%. Okay. All right, we're buying all of it, so company implied value is $810. The fair value of the assets was this 430 that I calculated over here. So price paid minus the fair value of the net assets, and our goodwill was 380. Right, it all belongs to the parents because we do not have any non-controlling interest in this case. We've got all of it. Okay, then the next thing you need to do, all right, this value analysis is a little bit new for us. The setup is, we did not do it in Chapter 1. However, it is the same calculation as we did in Chapter 1 for goodwill, okay? Now, the determination and distribution of excess. This one is new as well. We have not done one yet. So, a lot of the stuff is basically the same as what it was up above. We've got the 810. And of course, it's all ours because we bought all of it. Now, notice we're going to subtract out the book value. So the book value is based on their equity. All right, their equity is up here. I can make this bigger. Their equity is up here. It's the 20, the 180, and the 140. So 20,000, 180, and the 40. So it was 140. Sorry. So then you add that all together. Okay, we are buying 100%. Right, you can copy this over. We're buying 100%. So then multiply that out. And then the excess of cost over book value will be the 810 minus the 340. All right, so just copy that. Okay, now what we have to do is account for this 470. Where is this all going to go? Okay, and it's going to go into these accounts whose fair values are more than their book value. All right, so we're going to have inventory, land, buildings, and equipment. So we're going to have inventory, land, buildings, and equipment. And you're going to put the amount of the adjustment. So inventory went up by 20, land went up by 50. Oops, I'm going land went up by 50. All right, buildings went up by 30 and equipment went down by 10. Buildings went up by 30 and equipment went down by 10. Buildings went up by 30 and land went down by 10. Okay, now we have to equal this total right here, this number right here needs to equal this excess of 470. Okay, right now it's only at $90,000, but notice we have this goodwill right here. Okay, so you need to add in this goodwill of 380. And when you put in the goodwill of 380, it all balances out. Okay. I'm actually going to make this a different color. Okay. Then they wanted you to record the investments and any other entry necessitated by the purchase. Okay, so just to record the investment, that's where they gave them made the investment and they gave them shares of their stock. All right, that's not really where this goes. So I'm going to do that out here. Okay, so this is the entry to record the purchase. Actually, I'm going to change that to investment. Okay, so they made investment in Downs. All right, and to make that investment, they gave them common stock. All right, they gave them 18,000 shares. They gave them 18,000 shares. And the most you can put in there is the dollar par. Right? So the total investment is the 18,000 times the $45 fair value. Okay, so at 810. And then it's going to be split between common stock and paid in excess. All right, the difference here is going to go into paid in excess. Then they also had to pay $40,000 in acquisition cost. They had to pay $40,000 in acquisition cost. So that's going to be acquisition costs and cash. Okay, so that's part one, and we did part two. And then part three wants a consolidated balance sheet immediately subsequent to the purchase. Okay, so if you come down here, they have a worksheet where we can do our balance sheet. And notice we have this investment and we have their equity. Okay, and then we also have to make some adjustments. So what I'm going to do, basically we're going to add across to get our new balance sheet, but some things have to change here. So we're starting a little bit of stuff that we haven't really done anything with yet. All right, first of all, I have to increase the values of these assets up here, increase or decrease. All right, so inventory, I'm going to increase by 20. Land, I'm going to increase by 50. The buildings, I'm going to increase by 30. The equipment's got to come down by 10. All right, I also have to take off my investment. So I'm going to credit my investment for 810 because I can't have that on a consolidated. I can't have an investment in myself. All right, my stock, the equity section of Downs has to go away. So I'm going to debit those accounts. Okay. And I'm thinking, let's add this up. I know it's not going to total out. Let's add it up. Oh, it doesn't. Okay, now let's see what we're off by. 820 minus 440. All right, we're off by $380,000. Have y'all seen that number somewhere before? Let's go up here and look. You see this goodwill? All right, goodwill needs to come on here as well. Okay, so goodwill is my 380. It needs to be added in here. Oh, sorry. 380. All right, and now notice this all balances out. Okay. Another thing I want to check. Okay, one other thing I want to do that we haven't really done yet that's not showing up here is I'm going to take out, we had these acquisition costs of 40, okay, and that's not reflected down here anywhere yet. So I'm going to go ahead and take the 40 out here. It would actually have been posted like when you did closing entries and stuff. It's not something we would normally do an elimination for, but I'm going to take the 40 out of my cash. And I'm also going to take it out of my retained earnings because it would close into retained earnings and bring it down. So now you can add this across. So plus the 50, plus 70, minus the 40. This one is a debit, plus a debit, plus a debit. This one I can just copy this and copy this down. Alright, this one though, I'm going to have to subtract that credit. Right. This one actually, I don't have it over here. I should just have it here. Because it's only going to show up on the... Oh, I'm wrong. I thought I was looking at goodwill. Let me put it back. So this is going to be my original debit of 810 minus my adjustment. Here's my goodwill. And I can just add these together. And I can just add them. They're going to come out, to be a negative because they're credits. All right, these I can also add. It's going to be a 0, so I can just copy that down. And the equity is just going to copy across. Just copy that down. And then this one, I've got to do the 420. And then the 40 is going to come out of it. And then you just add up that column, and if it balances out, it will equal 0. Because we have pluses and minuses for debits and credits. Yay! All right, and then you can actually do a balance sheet. You're supposed to actually do a consolidated balance sheet. All right, so you're going to do a formal balance sheet with assets and liabilities and equity listed out. Okay, the journal entry, then these things right here, not the 40,000, but this stuff right here in the middle, this stuff right here, this requires a journal entry. Requires an eliminating journal entry. And we use the word eliminating. But that was not actually part of the question, so I'm not going to worry about it. Okay, hope that helps.